You're listening to Heritage Radio Network.
HRN is food radio supported by you. Learn more at heritageradionetwork.org. I'm Allison Kane, and welcome to In the Sauce, a podcast about building consumer brands from the ground up. I love doing this show because I get to interview everyone from production gurus to marketing and social media mavens, anyone who can guide me on this crazy journey. This is the story of building Haven's Kitchen sauces, but it's also the story of every growing brand because we're all in the sauce. Today, I'm speaking with Kevin Griffith, founder and CEO of Amplify, an operational finance firm. Established 6 years ago in the consumer goods industry, Amplify has expanded into manufacturing, agriculture, and tech. Kevin and his team help companies like us scale by managing key processes in a data-driven environment. We'll dissect what that means, serving clients from startups to $500 million businesses. I should also mention that Kevin has been a CPA, a lawyer, and a wealth manager. He's become an integral part of our team and a good friend, and he's from Nebraska, which is a fact, but I think it's also symbolic, and we'll talk about that. Welcome, Kevin.
Thanks for having me, Ellie.
Yeah, you've been wanting to get on here for a while. You've been wanting to talk about money and finance and all of it.
Or, just shoot the breeze with you. That's always just fun.
Yeah, super fun. Before we get started and we get into like nitty gritty, I feel like you have a lot to say about the way that companies think about their finance function. And I would like to hear your just kind of 1 minute rant on what you think the problem is with the way that CPG startups deal with our money, think about our money, and what you wish everyone that was starting a consumer goods company knew or thought about more.
Yeah, it's a good question. I think the problem with consumer goods is so complicated. Mm-hmm. Even though at the end of the day, it's all about unit economics. And like every business, it's funny. Every business has the same math. It's all about unit economics. It's all about how are you able to sell X number of units to cover your operating expenses, your SG&A. And, what we often do is we get into, what's contribution margin on a unit basis, like, that whole thing. But that core concept, is so foundational and it's intuitive to most founders and operators going back, basically since the beginning of time, because that is literally what all businesses is. How do I take these unit economics, trade enough volume, and then how do I scale it? And so, that's one thing that I think you can lose sight of. It's not like people don't know it. I mean, it's not hard, but there's so many other moving pieces. And especially in CPG, everybody's trying to take their nut, and the way you take your nut is you make it really hard to understand, right? Like, and you see that a lot in like agricultural commodities, the way they do pricing. And at the end of the day, pricing is not as straightforward as it should be. And the reason why is because the more you can cloud the market, right, the harder it is for people to extract
what your actual value is.
Yeah, then you have to actually earn your margin.
Right. I mean, that's when you said that, I said brokers, but you weren't talking about, you were talking about other things. Yeah. But going back for a second, so, because I like this tack, and then we'll get into like stuff, but generally it seems like it's not so much that founders lose sight of it. It's that when we enter this like world of scale and growth and exit and giving away equity in something that is basically a hope of future growth, right? Like we get fancy in our footwork Like, there are a lot of people that I meet outside of this industry that's like, wait, how can you be an X million-dollar company and not profitable? How is that a company? And I'm like, well, in our business, there are $100 million companies that are doing that much in revenue that are not profitable. And they're like, well, why not? How is that possible? Like, do you think it's that there's been so much money sort of speculating in this industry for so long that we've forgotten the basics, or we're just kind of hoping?
When venture money comes in, or call it, high risk, high return type money, it turns into real estate development, right? Basically, what you're hoping happens is you build this thing that on its own, you can't necessarily turn into, an ongoing business that's going to hit the returns that, the capital came in at, but somebody else can. And so then you're trying to then sell it to somebody who can extract that value. And so you're speculating instead of trying to, do those business fundamentals, compound cash flow.
In other words, when you're subscale, it fundamentally doesn't work. And the idea has been for the last however many years that with that scale, whether it's distribution efficiencies or COGS or, whatever it is, that with that scale, all of a sudden the economics flip into, well, now this works.
Yeah. And what happened too, I think, is you remember go back 30 years, food was more regional, right? You didn't have national supply chains. You didn't have this kind of national market. When the national market opens up, now your growth curve looks very different. And so then that's going to attract different kinds of capital than, go into the kind of return that you can get with such a big national market that gets created. So it's very much driven by market economics and how you, flow into it. And it's changing because now kind of that not easy, but you go from 10 to 100 million, that path is not what it used to be. It's not as simple as that anymore. And so now you're starting to think about, well, how else can you turn it into a viable business that creates margin that you can control more, right? You're starting to see a lot more brands go deeper in their supply chain. And so it's getting reinvented. And a lot of the contraction in the capital market, the last 24 months is part of that is a lot of bets were placed that aren't going to pan out because it's based on an economic model that's really becoming much harder to execute than it was when the money went in.
So I have a way of being really reductive, as you know. And one of the things that I've been saying lately, and I want to just like pressure test it with like someone from Omaha, is I feel like there are three ways that you can not necessarily win, but protect yourself or build a moat around yourself right now as a founder in this industry. One is just have an impeccably, reliably, unfairly high margin. And that means you are not being particularly innovative. You're not using ingredients that are a little bit more esoteric. It means you're probably going to have sugar and salt and a lot of water in your product. Cheap is another way to put it. That's one. Two is an unfair advantage when it comes to awareness, so that you spend zero on customer acquisition, a la a celebrity brand, an influencer brand, etc. And three is just what I like to call a fuck ton of cash. So you are backed by a bigger business or by a family office that is just ready to just bankroll again to give you the time to get to scale. Is that reductive?
Well, yes and no. I think the margins are a derivative of a competitive advantage. They're an indication of a competitive advantage. They're not actually a competitive advantage. So like what you're really saying there is, hey, you're just going to be cheap and you're going to be the low cost provider, right? And there's well documented.
Or there are brands that are doing a really good job making products that are not expensive, but have somehow created a premium aura around themselves,
Right.
a la Oreos
Right.
compared to, Ronzoni or whatever, ragu. Like there
Right.
was nothing particularly premium in that formulation. They just did a really good job holding their space. That was smart.
Right. Yeah. Yeah. And that, so then that's that branding, the positioning, like that's ultimately what their advantage is, that allows them to that allows them to get the margin on shelf. Right. And what's been interesting, like you look at the really big food brands like General Mills and Conagra, like they struggle to keep their margins. Like the whole point of a brand is so that when you get hit with inflation, you can pass the inflation on, and when inflation goes away, you can stay where the price is. And like private label's gotten so good, right, in terms of product quality, and retailers make so much money on it. Your margins are starting to erode, and like the propensity to pay for a branded product versus the private label, like it's 20 to 30% higher. It's not a huge markup, and so then you really have to start winning on product. Like, and it's not okay, I've got a Me Too product and like I'm changing one or two ingredients. Like you have to come up with a product that goes all the way through the supply chain that's differentiated, right? So what that means in like classical strategy talk is I'm going to make certain decisions that other people won't replicate because it's, cost prohibitive.
Like us with pouches.
Exactly. Right.
But the thing is, those pouches continue to bite us, right? Like everybody who looks at us is like, put it in a bottle.
Then you get into your scale question, right? And so then it's, okay, can you get enough scale to drop the cost down? And what are those scale increments that need to happen? And that's the bet you make, right? And so it turns into this very holistic, and this is what strategy's always been, is how do you put all the pieces together internally so that externally you can carve out something that you can protect. And it's not just one decision that'll make it. It'll be a confluence of decisions working together. And those are the best strategies.
All right. We're going to take a little break because I feel like we got off on a really good sort of like deep discussion. And now we're going to get into like define this and let's talk about that. And we'll do it all in one fell swoop after the break.
This episode is supported by HRN Business member Gustiamo, the place to buy the best Italian food online. Gustiamo imports the most authentic food from Italian farmers and food makers dedicated to their food and traditions. Make Gustiamo your online store for ingredients and pantry staples from Italy. Visit GUSTIAMO.com. Gustiamo supports HRN's creative educational reporting and storytelling that drive conversations to make the world a better, fairer, more delicious place.
I'm back with Kevin Griffith, and we are talking about the sexy, juicy topic of operational finance. People, I think, really like the branding and marketing episodes of this. And I do one of these every once in a while because I actually it's not a core competency of mine. And I think it's really interesting. I also think what you said at the beginning is really true. Like I came from a brick and mortar, where there was we had a line of credit because I was told that was smart to do in case of an emergency, but there was no, you had cash and if you had cash, you spent it. And if you didn't have cash, you waited until you had it to spend it. And it was profitable. I mean, there was no one there to subsidize it if it wasn't. And there was no fancy footwork to be done. We got deposits, we got things, we had to pay for ingredients. We tried to get as good payment terms as we could. But so when you said before at the beginning that this is intuitive stuff and it gets cloudy, it really does. And I'm going to start with one thing, which is operational finance. That sounds like just finance and running just making a business operational. What do you mean? What is that? And why is it different?
Yeah, it's a good question. The way we look at it is there's three kinds of finance people out there. There's somebody who grew up in accounting. And so they're very good at accounting. They're able to close the books on time, and they work very well with systems, right? So your accounting system, your ERPs, your inventory management, all that. Then you have your deal guys, and your deal guys grew up in investment banking or private equity, and they're really good strategic. They're really good thinking through business models, et cetera. But they're typically not very good at systems. Like you don't want your deal guy going in trying to implement an ERP.
Mm-hmm. Can you just define ERP for people?
Enterprise resource management system. An ERP is like NetSuite.
Got it.
Like where your entire company's run on one system.
Got it. Okay. Does QuickBooks count as that?
No, QuickBooks is just an accounting system.
Okay, cool.
And so we integrate QuickBooks with Deere or Sin7 now. And then you use our platform to then suck up the Whole Foods data, the UNFI data, QuickBooks, Target, Spins, all that. That way you don't know that you have multiple systems. You just log in and look at the data.
I hear you. There's the accounting, like the systems guys. There's the deal guys who are usually the investors and the Wharton folk. And then there's you.
And then there's what we call operational finance, which, predominantly is, 3 key processes in a business. And these processes are very important to scale because the way you scale is you push decisions down. But as the CEO and executive team, the more you push decisions down, the less control you have. So how do you make sure you're controlling your economics? And that's what operational finance is.
Okay, so when you say push decisions down, you mean you delegate to people on the team who are deciding we're going to order 50 instead of 100. And as you lose that control, you don't want to lose control of the finance piece.
Exactly. You don't want to lose control of your P&L or your working capital.
Okay. So that's the way you scale. That's the way you scale your team.
Right.
Okay.
Right. Well, and yeah, I mean, they're core business processes that need to be executed as you hit growth.
Okay. So what are they?
So one is financial planning and analysis. And so think about the big financial model we always go through.
I hate it.
I know. It's great. In all its detail.
Is that when you say that? So when I think of that, I think of like when I'm like, let's do a line by line. That's my favorite. I always say, let's do a line by line. And that means like, I want to look at everything that we're getting.
Right.
And if we're really getting it, or if it just looks like, if it's fake getting, and everything that we're spending.
Yep. And so that process though, so you're kind of describing the activity. The process is, every quarter at a minimum, you're running through what's been happening, what's our outlook, which product lines are performing, which customers are performing, is our costing in line? So then it starts to feed into, costing and then getting back to those unit economics and like checking against contribution margin. And, we're doing this monthly, but so it's almost like a quarterly budgeting process. Mm-hmm. But the thing is when you do something more frequently, it's less work. And if you set it up right, it's not a lot of work. And so like when you go line by line, like really that's a budget process, but we knock it out in 60 to 90 minutes, right? It's just not, so if you've got the data set up, you've got the model set up the right way. And what the FP&A process is really controlling is it's controlling everything outside of revenue, and everything outside of revenue and everything outside of your material costs, like cost of the product.
And FP&A stands for financial planning and analysis. And does that include forecasting, budgeting, cash flow? All that. That's the whole Megillah.
It's the whole kit and caboodle.
Okay.
Yeah.
Okay. See, I say Megillah because I'm a New York Jew, and you say kit and caboodle because you're from Nebraska.
Yeah.
But they mean the same thing.
Yeah.
Okay. Is there a difference between budgeting and forecasting?
So a budget is usually what you set your incentives on. Meaning like when you do your budget, you go to the board, you get approval, and then CEO is going to get paid X on this performance, CFO is going to get paid Y, and so on and so forth down the chain. And then as the forecasts come out, you're comparing against, how you expected to perform. And then like your budget is your forecast, except you're not going to get incentivized on your forecast.
Right. So your sales team is incentivized against those numbers.
And as the organizations get bigger, it allows people to track to, well, what was my expectation?
Right.
It's a bit arbitrary because it happens at the end of the calendar year or fiscal year, but it's people need the incentivization.
Right.
Matter.
Incentive. Yeah. Okay. So there's, again, the core components of operational finance. There's making a budget, forecasting, which is part of it, but also the forecast can shift, whereas the budget probably stays pretty.
Budget doesn't move.
Yeah,
right.
Budget doesn't move. And the variance between the two is, I actually know a bunch of companies when they had these sort of like model-y, financy types doing their operational finance. And this actually happened to us at some point too, where we weren't actually planning our spend against what was really happening. We were planning our spend against the model. And no one said, hey, like you actually didn't make $1 million last month. You made less than half of that, So what would you advise there? How do you mind your P's and Q's on that right now? Like, how should someone like me, if I didn't have someone like you, really get in there, not being a math or a model person, and just like know what I need to know so that I don't run out of cash and I keep myself really tight?
So I think it's really going to be around understanding where break even is, especially for most small consumer goods, helpful. Because you can do that math in your head, meaning, okay, I need X amount of revenue and Y amount of margin dollars, and roughly my SG&A is going to be at, X number of dollars.
Okay, give me use real numbers so that it doesn't sound like gobbledygook.
You've got $300,000 in revenue monthly, and I would always kind of look at it monthly unless you have a really seasonal business. But even still, like your cost structure, so $300,000 monthly, and I've got a contribution margin of a third just to make the math easy. So I have $100,000 in margin to cover my SG&A. And so if I've got $200,000 in SG&A a month, and that includes, payroll and typical fixed costs or a little bit of discretionary spending, but generally that's not moving around more than, 10, 15% on a given month, right? Then you're operating at $100,000 loss. And every month. Then in order to make up that loss, you're going to have to figure out how to sell that loss divided by 33%.
Or you have to make your loss not $200K a month.
Or cut back on your spend.
Right.
Yep,
okay.
Exactly.
So that, exactly. At the end of the day, it's like personal money, right? Like in the same way that you either don't buy that extra lipstick or you do a couple hours more of babysitting to afford that lipstick.
Right. And so one way to think about it too is if your budget was, okay, I'm going to lose $1 million this year because I raised I want 24 months of burn. Let's set aside the purchasing and the working capital management for a minute. Okay, I can only burn $1 million. I burned 150 one month because I only sold, 200,000 in revenue. Mm-hmm. Well, I got to make that up. Either you have to cut to get the 50 back, or you're going to have to bank on growth. And maybe, an order slipped or, based on what expectations were, like you'll know the context, but like back of the napkin math, I have 2 million. I want to spend $1 million. If I lose an extra 50 grand, where am I going to get that from?
Right. Yeah. A lot of wishful thinking. Everyone, I'm just letting you know I'm a little cranky today. It's a little bit of a cranky Monday for me. So sometimes you hear me all jazzed up. And right now I'm like, I'm just being realistic. Okay. So you were about to say, so then there's the S&OP, which is the sales and operations planning. So tell me about that.
So the sales and operations planning is really the best. That's how you control cash, right? Mm-hmm. there's lots of things that go into cash, and that comes out in the 13-week cash flow and things like that. But this is really, we're talking about inventory, and inventory for a lot of businesses is the hardest thing to manage because you could have spoils quickly. You've got minimum order quantities. You've got to buy componentry if you're not buying finished goods. And like your biggest spend is generally the cost of your product.
Mm-hmm.
And so the S&OP is a dedicated process that you're using to manage that as tightly as possible. Because the likelihood you're going to miss payroll month to month is zero, right? Like you have payroll, unless you've got, somebody you're paying hourly, a lot of them, like you're not going to miss the budget on payroll.
Right.
Or if you do, you're going to know why. But if you're going to miss, it's usually going to be revenue or it's going to be your material costs. And, material costs for most consumer goods businesses is not something that changes a lot very frequently.
Right.
And so really you're talking about revenue. And so what we do is we go bottoms up, SKU by SKU, customer by customer, retailer by retailer, and roll that then into the channels like UNFI and KeHE. And that way you can start to see what their ordering patterns are, and track and then buy against your projected demand.
Right.
And, you break it into different things. Here's my replenishment. Here are my fills. Here's my incremental, assumption on velocity if we're running a promo or something like that, to make sure that we have enough inventory, but we're not taking too much.
Right.
Or if we are taking too much, we know we are, right? Because sometimes you just can't get around a minimum order quantity.
Right.
And then at least you're understanding this is a risk that I'm taking.
Right.
And, all of this is about understanding your risks and your rewards, not just like the number must be right.
Because the number's never going to be right. That's one thing I learned very early. Like you either make too much or you make too little, and you have to mitigate the pain of both sides and decide which one you're more comfortable with. Right.
Scale is really one of those things that helps because it allows you to put, like if you say you've got Whole Foods is going to order $100,000 in one more month and they order 80. Well, if you don't have another customer, there's nowhere for that to go and you got to sit on it. But if you have lots of other customers, now you have a deeper market that you can sell into.
Right.
Promoted or otherwise. Like it just scale helps smooth out the numbers, law of large numbers kind of thing.
Scale is the name of the game in this kind of business. Is there anything, speaking just like, because you do have, you have a bunch of different companies that you work with. Is there anything you're noticing specifically about, let's say, UNFI and their ordering? There was a thing a couple of years ago, someone was like, they close their books on May 1st. So April is always, they try to get away with as little as possible so they have less inventory. Like, I don't know. I don't even know what that is all about. But is there something you've noticed about their ordering patterns?
Well, I mean, their ordering, and you get me in trouble, but the ordering is automated. So it's all algorithmic. And, UNFI's, like, their accounting practices and their billing practices, it's definitely something you just kind of, you just sit there and you go, what's the SEC doing? What's like, they have long-term contracts with Whole Foods. You just sit there and you're like, and, they get sued all the time for, they'd have bill backs for the wrong brands. It's just, and it's like, yeah, okay, you're not doing it intentionally, but like, if I do it, if you're negligent or you're intentional, I don't care. Like, yeah, I'm still in trouble because of this. Like, why is this my problem? But that's not, that's just not how apparently anybody looks at it.
Right. No, I think, from the brand side, it's the cost of doing business. Like you can gripe about it, but we're not changing it. And I'm certainly not like making it my life's work to like get in it with UNFI.
Yeah, and then they just took another 2.5 points on this whole new thing they released, and it's a cost of doing business. I don't think the retailers understand just how much margin that UNFI takes because they don't see it.
Right.
But it's 5 points more than they say it is, and that's just how you have to budget.
Right. And so, is there anything in terms of it's algorithmic based on when you've like made your OIs and last year's ordering?
Yeah, they're looking at some kind of trailing. So the startup, new products, whether it's a new brand or not, in particular, it's hard just because there's not a lot of data, and you have to try to get a hold of somebody at UNFI, to make sure that they're in stock. And so you have to be looking at those service levels and the holding levels a lot. Now you got to pay 2% to get the data, two margin points.
And by the way, while we're on it, one of the things that actually is a lawsuit right now, I think with it's a class action with the FTC, is an Amazon issue that is coming up where unless you de-check a box basically as a brand, I believe it's UNFI and K, they have, they sell your product to third-party Amazon, I don't know, vendors, I guess is the word.
And resellers.
Then resellers who then lower the price below you, get the buy box, and basically force you into lowering your price to just be able to own your own brand. So that is a bummer.
Yeah, that makes sense. I have not looked at antitrust law in a while, but that's what Microsoft got in trouble with Internet Explorer, is that was the default and you couldn't make it the undefault.
Yeah.
Or it was buried. And so it's a bundling violation under the antitrust law. That makes sense why there's a lawsuit.
Yeah, for sure. That will, I guess, be resolved in 14 and a half years. And I will be not doing this, hopefully. But mazel tov to UNFI. Okay. So there's nothing you can tell us that's helpful about, demand planning regard to UNFI. But I'm sure there is something that you can tell us with regard to demand planning generally, or things that you've seen.
Yeah, well, in the demand planning, you're incorporating the UNFI data, like, hey, UNFI, this DC is running low. Someone try to get a hold of them, see if they can't get an order. And then, that flows back through to your purchasing. Okay. And so it's trying to not only manage what you're buying based on what you think UNFI is going to order, but you're really looking at the whole supply chain. And if you have good enough data, you can start to look at sell-through rates of products at point of sale to see unit movement all the way through to the store. And then, trying to, it's not perfect again, but at least you're making an informed decision like, oh, okay, I'm trending higher on some of these products.
We had that happen. UNFI was chronically under ordering for a while, and we finally got someone on the phone, and they had just it wasn't dynamic algorithming for sure. It was like an old plan.
Right. No.
And their ordering was just.
Yeah. I mean, it's a simple, and if you think about it, for scaled products, it works. Mm-hmm. Right. If you've got most of UNFI's distribution, it's going to be pretty consistent. Maybe there's some seasonality or OIs, but I can see why it works. Right. And then, UNFI, if you think about their mind share of their customers, they got to deal with the retailers and they got to deal with the brands and the small brands, they're just not a priority, which, makes sense. Yep. Economically, they're probably not making it much money.
Scale.
Right.
Okay. So we're going back to the core components of operational finance. The first is that financial planning, FP&A. The second is S&OP. I love all these acronyms. What's another? You said there were 3 core component of operational finance.
The other one really is kind of just a BI, a business intelligence.
Okay, what is that?
Capability. So that is the dashboards.
Okay.
But basically, especially in consumer goods, you have so many different sources of data. Having the ability to have all that at your fingertips enables not only the processes, the FP&A process, that S&OP process, but also keeps everybody informed as to what's going on and, try to keep everybody on the same page.
And so I've gone back and forth. I love having Allie's dashboard, but then sometimes it makes me sad. It's great when it goes up, and then the next week it's and then the next week it's a little too volatile, I think, for me. But that's just a personal, preference. But again, going back to what every founder should always know week to week you have all of this data. What is the noise? What are the signals?
So week to week, the thing about
or month to month
CPG, I mean, it's a slow moving business, especially at retail, just because your decision points don't happen very often, right?
Mm-hmm.
The buyer's not buying every day. Yeah, you're going to run promos, but you're setting that calendar in advance. E-com's a totally different ballgame. That's a minute to minute kind of thing.
Right.
But what you're always want to focus on is that value creation formula, which is, what are my velocities? What's my contribution margin? And how many points of distribution do I have? Because those are the three things that drive value, not only to the bottom line, but to your, enterprise value of the business.
No, I want to double click on velocity. Obviously, if you have been listening to this podcast at all over the last 6 years, it's like, I think I use the word velocity 18 times an hour. That is your units per store per week, or it could be your units per SKU per store per week, depending on how you slice it. But you obviously, once you have basically acquired a customer or paid, whether that's in a free fill or a slotting or just in attention and resources, once you've acquired that customer, you can sell 1 unit a week or you can sell 5 units a week. And you're now basically just trying to extract as much value out of that cost of acquisition as possible, is the way I see it. It's the repeat purchase. It's the building loyalty. It's the we're in someone's cart every week. And it's also basically the key indicator of whether or not you're going to be able to break through the noise. I know some stores, I think Target looks at dollars. I just think velocity is just a really critical metric.
Yeah.
So that's one thing everyone should know. You should know how many units a week you're selling. You should know where you're selling more units. I remember Peter Rahal really early on in the journey was like, know where it's working and why it's working, and know where it's not working and why it's not working. And just, it's not going to work everywhere. So really lean into where it is working. Velocity. Contribution margin, you have explained to me a few times. This is a new one to me, because when I was coming up as a young CPG founder, I knew there was gross margin, and I knew that I wanted that in like the 60% range. And I knew there was product margin, 60% range. Then you have your trade spend, which we averaged around 20%, and that got you to your gross margin. And 40% gross margin was like the target number.
Yeah.
So can you just tell me why contribution margin wasn't as much of a metric during the go-go years? It is more so now. Can you just break down sort of the way that you think about these different margins?
Yeah. Contribution margin is a managerial accounting term. Mm-hmm. So if you were to talk to an auditor, they would not bring this concept up. And contribution margin is really more like an economics. If you want to go get a master's in economics, you talk a lot about this.
Yeah.
But it's the incremental dollar or penny you're getting for the unit to cover fixed costs. In theory.
So it goes back to that 300, 200, 100, negative 100.
Right. And now in theory, gross margin includes all variable costs, but a GAAP is GAAP, and GAAP has lots of gray areas. So you think accounting's black and white. It's not.
It's the generally accepted accounting principles.
Right. You got it.
Thank you.
And there's a whole board. There's like a national board that sets these rules, and the rules are up for interpretation, and they have different nuances to them, like anything. And and probably a classic example that's allowed is freight. So freight to the consumer, to the customer,
freight out.
Typically, you can make an election if you're like on a publicly traded company because private companies do a lot of what they do, but GAAP allows you to make an election. You can make that part of contribution margin, or you can make that not part of contribution or part of gross margin or not part of gross margin. Because gross margin and contribution margin, especially for an outsourced consumer goods business, should be the same. However, you have different treatment under GAAP for freight. And so you can exclude freight out in your gross margin, making your gross margins look better. The other one does that make sense?
Yeah. Keep going and then I'll ask.
The other one is, point of sale advertising. So especially with e-commerce businesses getting as big as they are, and they'll continue to grow. Like if I've got to pay $20 to get a purchase, that's a true variable cost. I need to make sure I'm covering that in my margin and in my pricing to help me get my absolute variable dollar in when I sell one of my products. And advertising for sure is not part of gross margin under any situation.
Right. So contribution margin is a little bit more okay, let's stop playing around. Let's see, if you are selling this for $1, how much you are actually making with all of the things that you have to do to sell it for $1. You freight it, right, all of them. And the goal, I think you're going to say, is 30 cents.
It depends. And so that's where if you go back to the equation, right, and I'm always surprised when people throw out margin numbers. I throw out margin numbers because people ask, but if you're buying, just trying to think of what I buy, if you're buying something weekly, your contribution margin doesn't need to be 30%, because that is a lot. That's a deep market. That is a lot of product coming off the shelf. Now you don't want it to be 5 because your margin of error is tiny. And so you're trying to find a sweet spot. And then ultimately, you really want to figure out your margins. It's what's your target return on equity, which is so outside of the concept of venture capital. Basically, how much do you want to compound cash, right? That's what margins dictate. And so, but if you've got a deep market, it's a big market, people are buying it every week, and it's just this constant thing. That's very different than if they're buying it once a month or once a quarter. Your market's not as deep, the velocities aren't as high, and depending on your rate of spoilage and shelf life and all that, you need to be paid. You need to have a higher margin to help absorb the fact that it's not as big as a market, not as deep or as fast as a market.
Why wouldn't you want just as big of a contribution margin as possible? Why wouldn't you just want that number to be as high as possible?
You do. It's just
unrealistic.
What's reasonable and how high, right, can you go? If you can get a 50% contribution margin, now you're knocking on beauty, and you pay $200 for a skin cream. That's just a different kind of marketing and a whole different business model than yogurt,
right? Or sauce with premium ingredients. Okay, so this isn't in the draft of questions, but it's just funny for me to ask you. If I was hey, Kevin, quit your day job, you and me, let's go. I've got the brains, you've got the looks, or whatever, vice versa. Let's probably opposite, I guess, sort of. Let's start a consumer goods business. What category would you choose right now based on everything you know? And would you want it to be high priced, less frequent, or would you want it to be lower priced but more frequent? I guess answer the question, then tell me why.
Well, let me come out a little different.
Okay.
Here are the things I wouldn't want to do. Wouldn't want to touch cold chain.
Thank you.
Cold chain is insanely expensive.
Yep.
You would want, anything where there's not a propensity to pay or you have very high private label presence. And so, that's why dairy, it's a terrible market.
Right. But then you have marinara sauce, which is I would guess 85% private label, but you have some of the best consumer brands in that category doing great.
Right. And I don't know why, but I'm also not category manager,
Right.
I mean, are they getting the margins above and beyond and, to make a good business of it, right?
Okay.
So they might be successful top line, but what does the rest of the P&L look like? I have no idea.
Got it. Okay.
But to answer your question, I'd want to have direct influence on the supply chain.
So you'd want to own,
I'd want to own, maybe not the assets, and if you can get away with being asset light, all the better. But if I don't have visibility back to the farm, I just don't think you can compete, because the supply chain is ultimately where things are won and lost, because that's where margins are, and that's where you can be more creative, not only on your margins, but your product development, your product development, research and development, and really come up with unique product. And going back to where we kind of started the conversation, finding ways to differentiate not only your product, but the entire business to create a better margin profile. Now, that works better with simple ingredient decks, right? Like you've got,
nut
dairy
butter,
or pasta or cheese or nut butter, right? Like you've only got, or chocolate, like you've only got a few things that you have to worry about. Now, when you get into like sauces or oleolis or things that have a more nuanced flavor profile, you've got a lot of ability on your recipe to create a differentiated product, but you're having to give up a little bit on, the back end in terms of cost. But you could still look at it and say, we've got X amount of seed oil, right, or olive oil in the ingredient deck. Like, how do I make sure my biggest ingredient is locked in? And like, how can I look at my production assets and maybe not right away, but scale into that over time? If not, I'd say go start a tech company.
Yeah. Okay, cool. What about high-end perfume that you have to get on a waiting list to buy because it's so special and exclusive, but it's basically like a 95% gross margin? Do you like that for me no. Okay.
Sneakers. They do that with sneakers really well. Where it's like a limited edition, but perfume, I think I know a guy in the space, and he's like, 90% of revenue comes for Christmas and 80% comes back in January.
Oh my God.
Because everybody returns it.
Well, not my perfume. They wouldn't return my perfume. All right. Last thing before we go, this has been really helpful, and we didn't even get to a couple of things, but that's because you wrote things like generative AI, and I was like, I'm not touching that. We'll do that in part deux. What are you telling all of your founders right now? Like, what are your words of like caution, but also your words of optimism?
Yeah. If you have a great product at a good margin, you can figure it out, because people will find a great product. And if you have a good enough margin that you're like, yep, I can make money at this, like, you've got a business. The business might not be worth $100 million, but you've got a business.
And the good enough margin is somewhere
north of 50. I mean, if you're sub 50, you're in for a slog.
Gross.
If you're, product margin.
Product margin. Oh,
if you got
great.
A 50% or higher product margin, 60% is the target I always give people.
Me too.
And it depends on the category. But if you're able to do that, and most packaged goods don't turn weekly, like it's a different kind of look, but you're in good shape.
Yeah, it's just going to be a slog to get there, but you're in good shape. Okay. Kevin, thank you. Thanks for everything.
Thank you.
You're kind of depressing, but in some way you also always make me feel better. I don't know if that's like the Nebraska thing or what.
Maybe.
But it's been awesome working with you, and I appreciate all of the moral support along the way as well. So thanks for coming on. Liam, thank you as always for engineering today's show. couldn't do it without you. And I have gotten so many nice DMs about last week's partnership episode, and everyone's been loving the one that I did with Ben from Lentilful. By the way, that's a business. That's going to be a good business. And so thanks for all the comments, everybody. And I'll be back next week with another episode of In the Sauce.
In the Sauce is powered by Simplecast. Thanks for listening to Heritage Radio Network, food radio supported by you. Keep in touch at heritageradionetwork.org/subscribe.